Hello, I'm Sami Zaidan. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, oil hits its highest level since 2014. We look at what's behind the rise of black gold. Also this week, anger over austerity. We examine the economic reasons for the protests in Tunisia. And it's all about China for Emmanuel Macron. He's been pushing for greater access for French companies. Oil has hit $70 a barrel for the first time since 2014. Brent crude jumped after OPEC said it would continue to limit supplies. The organization, of course, accounts for 40% of the world's output. Well, joining me from London is Naeem Aslam. Naeem is the chief market analyst with London-based Think Markets. Good to have you with us. So what's driving prices up?
There are three major factors. Number one, supply cut. We all know that. Number two, stability in the demand. But here is the most important one, which is the Aramco IPO. Investors cannot underestimate the importance of Aramco IPO because the entire reason Saudi Arabia is behind the price stability is mainly because of this IPO, one of the biggest IPO which is going to hit the entire globe. And I think because of that, we have seen that supply cut and the consistency of the supply cut throughout their supply cut decision.
All right, given what you said,
Naeem,
let me jump in and say, is this a trend that's going to continue?
I think it is highly likely to continue. I think that the price could continue certainly to the upside. Why? Because I think there is a stability in terms of a demand, especially the Chinese demand. If you look at the growth for the Chinese demand for 2017, we have seen 10% growth, nearly over 8 million barrels per day. That is literally what the demand is from China.
Yeah, but China's economy or economic growth is still growing, but it's supposed to be slowing down. That's not going to impact the situation with oil prices?
I think the entire geopolitical stability and the massive growth sentiment that we have throughout the world, I think that is also pumping this sentiment, that is also pumping this concept that, okay, we have a more stable grounds and then the growth would continue. And on the back of this growth, the price stability would also help the price of oil to move towards perhaps $75.
So how far can this go? Look into your crystal ball for us, will you?
I think it's difficult to say because we have come a long way from the lows that we have seen back in 2014. And most importantly, I do not think that OPEC and the members of OPEC wants to see more gain in the price, because certainly the more gain that we see, we're going to see more rigs coming back online, especially if you look at the numbers now. We are near enough to be 400 on the rigs, and if you look at the US crude shale oil production, that will also consistently rise with a higher oil price. So certainly we do not see too much of an upside. I think it's more of a consolidation from here.
All right, what's the bottom line for consumers? Are we going to see, I don't know, transports, flight, goods and services, all of those kinds of things go up now?
I think these higher oil prices will, of course, feed into an inflation, and that would have an impact on our daily life. I mean, over in the UK, we have already seen that in a number of different factors, but of course, the currency is an obvious factor as well. But through looking at from a global perspective, yes, higher oil prices have already started to feed into different parts of the equation in our daily lives.
Well, you mentioned OPEC's strategy a second ago. Is it going to backfire on OPEC if they continue making these cuts, in the sense that it will encourage more shale production in the US?
I think what would happen, perhaps, the compliance part of the equation will start to come down from OPEC, because certainly so far we have seen a really good compliance from most of the members here from the OPEC. But higher oil prices, what perhaps OPEC would do, the compliance will start to go down, and that would once again resurface the issues around supply cut, because we still have over 100 million barrels of extra supply. So if OPEC all of a sudden if all of a sudden they decide, okay, you know what, we are not going to have the same sort of a compliance as we had before, then certainly the production would go up, and it's a simple demand and supply equation.
US oil production is also now on track, we're told, to rival that of Saudi Arabia. How will that change the whole picture of global oil production?
I think higher oil supply is not that much of an issue as long as the demand is there, as long as we have a stability. So, if we have a balance between demand and supply, that's not so much of a concern. But if we only have a supply and not so much of a demand, then certainly it's going to have a negative or adverse impact on the price of oil. Then we won't see much of an upside. But like I said, we have come a long way from lows, when especially it comes to crude or when it comes to Brent. So certainly, I don't think that there's much of an upside here. But remember, a lot of traders or investors who have invested in black gold, i.e. your oil, they are in for a longer term because they are looking when Saudi Arabia is going to do the IPO, the biggest IPO, the Aramco. And I think perhaps that is the triggering point for them when they will start taking profit off. And that would have some sort of sell-off on the oil price.
Right. Now, interestingly, commodity-linked securities also rose to a 4-year high. When you put that into the mix, what's the bigger picture message here?
I think commodities have been undervalued in the past few years, and we have seen consistently rally in the equity market. But now, going into 2018, the entire Trump, let's say, the big sentiment around the positive sentiment about what Trump can do in terms of infrastructure, that is going to perhaps play. The tax equation would also come into play, and that will also perhaps boost more equity values. But I think both sides are equally looking brighter on the commodity and on the equity side.
All right, Naeem Aslam, thanks so much. Planned price hikes and tax rises have led to mass demonstrations across Tunisia. The budget took effect on January the 1st. It's hiked up fuel prices and also introduced new food and housing taxes. Many are furious over the austerity measures that will see thousands put out of work. Tunisia's Prime Minister Youssef El-Shah has tried to soothe anti-government sentiment, promising 2018 will be the last year of economic hardship. It follows protests in a dozen towns where demonstrators took to the streets, angry over price and tax increases. The hikes have been imposed as part of new austerity measures agreed with the International Monetary Fund. There have been protests in Sudan too. The cost of a loaf of bread there doubled after the government removed subsidies from the 2018 budget. The government says it's in line with reforms agreed with foreign lenders. Jordan's also cutting state subsidies on bread. Prices could soon surge by 100%. And recent protests in Iran were triggered by price rises for basic food items like eggs and poultry. Hashim Ahlabarra has the latest from Tunisia's capital, Tunis.
Although we haven't seen large demonstrations across the country compared to 2012, 13, 14 and 15, but the momentum is building up. There are young people taking to the streets across Tunisia denouncing what they describe to be pervasive graft culture and also impunity. The government is walking a political tightrope because on one hand it desperately needs cash and therefore it would like to maintain the austerity measures, but at the same time it cannot risk to further see people upset with their government taken to the streets. More violence in Tunisia is more uncertainty about the future of the country. But just to give you an idea about the delicate task that this government faces, the three main sectors Tunisia relies on for revenues are mining, agriculture and tourism, and those sectors were in decline over the last few years. So the government is going to the international community and to donors for help, but they are saying that, wait a second, we won't give you cash until you tackle the biggest problem in Tunisia, which is the public sector that consumes something like 12% of Tunisia's GDP. The government has decided to do the following: cut the public sector and increase taxes. But when you do this, people are definitely going to go to the streets. And if you see more protests, you are likely to see more violence in the future, more uncertainty about the future of Tunisia. And this is where the government now is facing this mounting pressure to try to implement the reforms, maintain the austerity measures, but at the same time convince the Tunisian that those measures are for the benefit of Tunisia.
Still to come on Counting the Cost, horse trading and deal signing. We'll have more on what this 9-year-old gelding has got to do with China and France. A highly classified US government satellite appears to have fallen into the Indian Ocean after being taken into space by Elon Musk's SpaceX. The military satellite hasn't been spotted in orbit since it launched on the 7th of January. It's suspected the Zuma mission burnt up in the atmosphere after failing to separate from the upper part of the SpaceX Falcon 9 rocket. French prosecutors are investigating Apple over its admission it deliberately slowed down older phone models. The inquiry focuses on planned obsolescence, a commercial practice forcing consumers to periodically replace products. That's illegal in France. Apple says the slowdown is intended to extend the lifespan of phones by putting less pressure on aging batteries. Pfizer has decided to end its research into finding new drugs for Alzheimer's and Parkinson's disease. The world's largest drug company says it wants to cut 300 jobs and redistribute the money. The UK-based Alzheimer's Society says the move will come as a huge blow to the 47 million global victims of the disease. The presidents of France and China have signed trade deals worth billions during a partnership-building exercise. The 3-day visit aimed at deepening economic ties. It even saw Emmanuel Macron woo Beijing with Airbus planes and a horse. Both leaders promised to promote free trade and combat climate change, a vision that's completely at odds with that of the US President Donald Trump. Rob McBride has more.
China and France are hailing this visit as a new era for strategic partners. Xi Jinping and Emmanuel Macron signing multi-billion-dollar trade deals from aerospace to nuclear energy projects, and reaching what they say is common consensus on a range of issues from climate change to international security.
We have made an agreement to improve global issues. We are faced with climate change and terrorism. China will be working together with France so we can have a win-win situation and develop a new strategy that helps everyone in the world. We have both agreed to have open and deep communications.
Macron says his visit is a recognition of China's role on the world stage and Xi's preeminent position as Chinese leader.
Sur le plan économique, nous l'avons évoqué avec le président Xi.
On the economic front, we discussed it with President Xi. We know where we are going. After a long situation of asymmetry, we decided several years ago to rebalance. I would like this rebalancing to translate itself into more Chinese investment in France and into more access to the Chinese market for French companies. It's the right way to get out from the current situation we're in.
This is Macron's first state visit to China as president, and he wants the trip to become an annual event, to highlight the deepening relationship between China and Europe, growing stronger as their respective relations with the United States become more unpredictable and strained.
And I think it is time for European leaders, including the French President Macron, to really balance off their relations against the United States with their relations with China.
Macron began his visit in the ancient city of Xi'an, one of the starting points of the ancient Silk Road. His full support for what President Xi calls his Belt and Road initiative of new road and rail links, seen as the modern-day equivalent of connecting East with West, is popular here.
Joining us from Paris is Philippe Vechter. Philippe is the chief economist of Paris-based Natixis Asset Management Bank. Good to have you with us. So with Brexit looming, is business with external markets like China looking ever more attractive to Europe?
Clearly, it is an attractive market. You know, we are in a recovery period, and the Brexit is just something we have to manage. But we have strong growth in Germany, in France, and you know the eurozone, the euro area, and Europe is still a main trading partner for many countries in the world. So the recovery in Europe is important for everyone, from the US to Africa to Asia, and that's what we have to keep in mind.
All right, but Macron made it clear he doesn't just want more business with China. He wants more business and trade on a more equal footing. Does Europe have the leverage, though, to force more equal access to Chinese markets?
Well, I think that it was the first step in the European strategy. You know, when we look at world trade, there are three champions: the US, China, and Europe. And we've seen in recent months with Donald Trump that US follows now a more isolationist strategy. So we have to draw a new equilibrium and between China and Europe. And that was one part of Macron's strategy in China, to say Europe is now an important trade partner for China, and we have to discuss to find a new equilibrium. So that was the first part. The second part, it was about reciprocity, saying you export a lot to Europe. We want to have a more balanced trade with you. It's a complicated story. It will take time.
Let me just jump in there, because you talk about a European strategy. Is there really a common European approach to China, though?
I think we have this. We have to keep this in mind. It's something we have to discuss. We have to think about, because we know that Macron, Merkel, and others have discussed around that, and we want to. Discussion we've seen in Europe for the last year almost is to say we have to replace Europe in the world, and so that was one part of the strategy. First part was to recover, to have a stronger growth, and second part is to say we are an important partner for everyone in the world, and because we are very high productivity level, we are very rich, we are very productive in Europe, so we have to keep our place and not being, as we saw in the past, a strong economic partner, but a very little partner on political side.
But Philippe, what we're seeing is that the sort of conversation you're talking about, or the sort of ideas you're talking about, is not just a conversation European countries are having. We're seeing real differences, are we not, in the approach to China? Some of the countries in the south of Europe, which are recipients to substantial amounts of Chinese investments, for example, they have a different take on China-related issues than their counterparts in the north of Europe, right?
Yes, I don't say we clearly have a country-by-country unified strategy, but what we see from Brussels to Berlin and Paris is to say we have to develop a more global strategy on trade, and specifically with Asia and China. And clearly, the point is to say we know that in Greece or in other countries there was a lot of Chinese investment. We need to have this investment, but we want to be able to control them a little bit. That was not the case until now.
And here's an interesting one. I mean, just looking at some of the highlights of Macron's visit to China, do you think he was trying to position himself as, I don't know, leader of Europe?
No, I think his target, Macron's target is to reshuffle European unity, and he wants to transform Europe, and not as a kind of mosaic of countries, but like a global partner for everyone in the world. That's what he said. He discussed with Angela Merkel last June, and that's clearly what he wants to do at the global level.
All right, Philippe Vechter there. Thanks so much.
Thank you.
Well, joining us from London now is Tim Mulligan. Tim is a senior analyst and research director at Media Research. Good to have you with us. So what caught the eye at Las Vegas for you?
There are a number of things. What is of particular interest is the renewed emphasis on voice. And voice is a particularly interesting technology as we move into 2018 because of the implications for unlocking the older demographics who, first of all, have been in many ways bypassed by the streaming revolution that's happened over the last decade.
But voice activation, Tim, is not an entirely new technology, is it? Would you say that this is the next big theme?
Yes, so if I caveat that, agreed, it's not an entirely new technology, but this is the year that it starts to really make traction towards the mainstream consumer.
So that's where you put your money.
At how technologies, yes. So, yes, I would say that voice is the most likely to unlock the older demographics into the streaming revolution.
We look around at some of the gadgets, from washing machines you'll be talking to suitcases that will follow you around on their own. Are we on the verge of another revolution that is going to change life as we know it?
Well, maybe we're actually reaching the realization of the Internet of Things scenario that's been played out a number of years ago. In my recollection, I think it was the 2015 CES where the Internet of Things was heavily pushed, and you had things like toothbrushes that you could talk to and could personalize your dental hygiene. Now that was a little bit ahead of its time, but we go to where we are now, where we have, for example, in the US, 46% of US consumers now stream Netflix. The use of digital content, the use of digital experiences, smartphone penetration, these are all now either at the mainstream or right on the edge of becoming mainstream. So this really is, in many ways, I agree, this is the tipping point where we're entering into a new era. The other thing that's significantly different is if you look at the key players who are pushing this technology, the tech majors have an unprecedented level of control over both the content, the technology, the audience and the pricing globally.
Is that a scary scenario?
From the proposition of the end user, initially no, because you have economies of scale and you have much greater levels of convenience. But if we fast forward a number of years, you could well find that we are effectively operating under a number of companies which are able to do a number of things. So traditionally monopolies are worrisome because they control prices. But if you actually think about companies that not only are able to control prices, they're also able to stimulate demand based upon the data which they know about you. That's where the real concern comes for regulators at the moment.
And you mentioned data there, and I'm glad you did, because all of this means a lot more possibilities for collection and storage and dissemination of data. Will data be the next oil or gold rush?
Data is, in many ways, it's an easy way for companies who are in the process of digitization and for national organizations to utilize the concept of big data as a way to become more efficient and more smart at delivering outcomes. But we're in a situation now where there's no shortage of data, but there is a shortage of insight. So you can have as much data as you want, but if you don't know how to interpret that data, if you don't know how to deploy learnings from that data is not going to provide you with any additional value.
I have a feeling marketing companies are going to come up with a solution to that one. For now, thanks so much, Tim Mulligan there.
Thank you.
And finally, my number of the week is 379,000. That's how many hard copies and downloads have sold of the new best-selling book called Fire and Fury. The account detailing the Trump White House in its first 9 months has piqued our interest and jumped to #1 on Amazon. Good news for the author Michael Wolff. Whoever said the internet would kill paper publications, eh? And that's our show for this week. Remember, you can get in touch with us via Twitter. Use the hashtag AJCTC when you do, or drop us an email. countingthecost@aljazeera.net is our address. There's more for you online too at aljazeera.com/CTC. That'll take you straight to our page, which has individual reports, links, and entire episodes for you to catch up on. That's it for this edition of Counting the Cost. I'm Sami Zaidan from the whole team here now. Thanks for joining us. News on Al Jazeera is next.